Good afternoon, ladies and gentlemen, and welcome to this BTRM webinar. My name's Ed Dennison. I'm course coordinator for the BTRM, and it is my pleasure to host this special event webinar on the topic of strategic risk in banking. And given our antecedents, you won't be surprised to hear that when we talk about strategic risk, what we are really concerned with is how best a bank should address it in the context of the Internal Capital Adequacy Assessment, the ICAAP. In other words, how should a bank stress test for strategic risk on an annual basis as part of its ICAAP and draw conclusions as to what the stress test results imply for its Pillar 2 capital assessments. Like so much in banking and finance, there is more than one way to approach this conundrum, and conundrum it is because unlike more traditional bank risk types, such as credit risk or market risk, strategic risk does not lend itself so readily to a standard risk indicator set and orthodox stressed scenario approach. After all, it is most probably only in hindsight that one would have been able to warn Kodak in advance about digital cameras, or Nokia about smartphones, or Blockbuster about, well, you get the picture. Irrespective of the complexities involved, we know that this area is subject to ever more regulatory scrutiny. Banks around the world are expected to incorporate strategic risk in their risk register and to stress test it as part of their ICAAP. So we hope this webinar today is of value to you. With me today to present on this topic is Khaliq, who is a manager in Group Strategic and Corporate Planning at First Citizens Bank in Trinidad and Tobago. Khaliq, first of all, welcome, and thank you for presenting on this topic today for BTRM. I'm going to hand over to you very shortly, but before I do, just a reminder to our audience that you will not be able to unmute, at least not in the main section of the presentation, but naturally we do encourage questions and comments. So if you have any questions, please type them into the chat function and we will discuss them if there is time. And now I'd like to pass the floor to Khaliq. Sir, please proceed with your lecture.
Good morning, everyone, and thank you, Ed. Ed, can you confirm that you're hearing me?
Perfectly.
Okay, great. So I've already been introduced, so I'm going to get right into the table of contents. So today, I just want to set the context for strategic management first, before we actually get into the implications on ICAAP. So in a recent life, I was charged with the development and oversight of the bank's strategic plan. This area of strategic management is where strategic risk emanates from. So I'll briefly overview that process first. Of course, then Basil has made the link between capital and strategic risk. So I'll talk about that ICAAP context. And then I will going to discuss the nature of strategic risk itself. And then I'll speak briefly about how we could go about modeling strategic risk, and then some of the governance and monitoring around that. So let me get straight into it. So in strategic management, all the various processes can be abstracted into three main steps. So when we talk about strategic analysis and formulation, we're talking about coming up with that set of objectives, your mission, your vision. What are the initiatives that you want to pursue to achieve that vision? Strategic implementation, that speaks to project portfolio management. And is within project portfolio management is where you would want to address strategic risk management. Of course, strategic evaluation and learning is the third step of strategic management. So that's the high-level framing for strategic management and strategic risk management. Now, I'm going to address the first two steps a little bit more. So bear with me before we even get into ICAAP and modeling risk. So let's take a further look at strategic analysis and formulation. So in strategic formulation, a useful tool that I like to use is something called strategy maps. Many of you may be familiar with Kaplan and Norton's balanced scorecard framework. This is taken directly from that framework. There's material on this all over the web. Feel free to access. But looking at the strategy map, what we have on the left-hand side are the four balanced scorecard perspectives: organizational capacity, internal business process, customer, financial. And if you notice, in each of these perspectives, we've declared some strategic objectives, right? So you may have some objectives about culture transformation. You may also want to improve employee engagement. You may want to improve customer satisfaction or grow segments grow assets, improve profitability. Ultimately, all of your strategic objectives should be and ought to be linked towards profitability of the bank. So that's why this is the linkage between your strategic objectives and capital. So going across again to the right, we have KPIs and we have initiatives. Now, in order to achieve these strategic objectives, we must undergo some initiatives. So for example, if we want to improve employee engagement, we may undergo some change management initiative or some training initiative. If we want to improve our segment growth, we may develop new products. So these are the initiatives. So here's where this fits into the strategic risk context. Your strategic objectives are the things that are at risk, because all of these things link to profitability and ultimately capital gains or capital erosion in the bank. So these represent the things that are at risk, your strategic objectives. And on your right-hand side, we have the initiatives, and these are the sources of risk. And these sources of risks are twofold in that you can choose the wrong initiatives, and therefore they have no relevance to achieving these objectives. Or even when you choose the right initiatives, you just may not execute properly. And that's where project portfolio management comes in. So just a quick word on project portfolio management. So a project portfolio is a collection of projects and programs optimized toward achieving some strategic objectives. Project management is concerned with doing things the right way, and portfolio management is concerned with doing the right things. And many bodies of knowledge that speak to project portfolio management include risk management as one of their sub-functions or sub-processes within their framework. So it's within this discipline is where we manage strategic risk. So a little bit on the ICAAP context now. So we're all familiar with the P1 requirements. ICAAP goes beyond the minimum liquidity requirements of P1. It is intended to ensure that banks not only have adequate capital to support all material risks in their businesses, but that they also develop and use better risk management techniques in monitoring and managing these risks. And something from the Basel framework that I want to highlight is that a bank's ICAAP should address both short and long-term needs, hence the need for strategic risk. So going again, so my regulator in Trinidad and Tobago, they guide on strategic risk in that strategic business risk may impact on the capital of a financial institution as a result of 1, adverse business decisions, and 2, improper implementation of those decisions. So again, we're seeing that dichotomy of doing the right things versus doing things the right way. So adverse business decisions speak to, are we doing the right things? And improper implementation of those decisions speak to, are we doing things the right way? So we're going again. So let's speak a little bit more about what does strategic risk mean. So strategic risk is the risk of failing to achieve the bank's strategic objectives. So before we saw some examples, asset growth, market share, efficiency, for example. And we have some initiatives, technology initiatives, product and marketing initiatives, customer experience initiatives. So again, it speaks to that dichotomy in terms of the sources of risk. You have project risk, right? So, I mean, if there isn't proper benefits realization, proper project controls, etc. on a project, proper inadequate project governance, then projects can fail or take long to deliver benefits. Another source of risk is environmental risk. Of course, are we doing the right things? Even if you have the best project management office in the industry, you may be choosing the wrong projects. Your strategic decisions may not be relevant. And even if they're relevant, you may not have accounted for volatility in the environment. Are we doing the right things? So again, it's that dichotomy. So at this point, Ed, I mean, are there any questions that anyone would like to raise? Because I think this is the strategic context that I wanted to set and the sources of strategic risk. So, I mean, if there are any questions around that, I'm glad to field.
I'm not seeing any questions in the chat yet, just people asking if we're going to be distributing the slide deck after the webinar, which we are. That's going to be going out with the recordings probably tomorrow, I would have thought. But otherwise,
Okay.
I think you're free to carry on.
Great. All right. So we've had a background in strategic management, and I mean, where does strategic risk come from? So now let's talk about how it can affect capital. So personally, I have taken 3 different perspectives. And of course, I'm going to give some caveats around this in that there isn't much literature out there in modeling strategic risk. And even the approaches provided or described in modeling strategic risk, they're still a bit subjective and very high level. So that's the caveat I want to provide today. This is a sort of a scaffolding or overarching model that you could use to then instantiate your own, I suppose, approach. So with that caveat, let me give you my 3 perspectives on strategic risk in terms of how it can affect capital. So first of all, there's a strategic position perspective. So for any strategic plan, there's going to be some capital expenditure, right? There's going to be some sort of outlay with respect to technology, with respect to training, with respect to developing new products, with respect to research, etc. So you're gonna spend some capital, and of course the benefits may be exponential in the years to come. Over the next 10 years, this expenditure either could help you retain your current strategic position, if you want to take a conservative approach, or it could help you strengthen your strategic position. So for example, you may be number 2 in the market, and you spend some money on a strategic plan, you implement effectively, and in 10 years, you're now number 1. Right? So poor strategic choices can lead to lost opportunity. Now, using this perspective alone, right, meaning that if you don't implement your plan properly, can erode strategic gains. But using this perspective alone doesn't necessarily lead to a problem with capital. So even though your potential value and your potential gains are at risk because of improper implementation, because of environmental volatility, doesn't mean that you have a capital problem. It just means that you're not fully benefiting from the value of your investments. But it still doesn't necessarily erode capital. So let's look at the next perspective. So I'm going to add the perspective, what I call a return on capital perspective. So your strategic gains may lie well beyond some required rate of return. So your investors may be expecting, let's say, a certain amount of dividends or a certain percentage return on their investments, your shareholders, your investors, right? Your strategic plan may be giving you supernormal gains, 20% return on investments, etc., right? So any erosion in that doesn't necessarily lead to an erosion of, let's say, investor value. Now, if you drop below some sort of required rate of return, then investor value starts to become eroded. You're destroying values to investors, but still that doesn't mean that their capital is being destroyed. It just means that they're not getting the return that they would have expected. Now, at this point, you still may want to tighten your controls around how you execute your strategic plan. You still may want to consider maybe optimizing your portfolio so that you optimize your returns. But for me, my opinion, it doesn't necessarily translate to a capital P2 buffer. So now let's add the ICAAP perspective. So not only can initiatives fail to meet a required rate of return, but it can also incur costs or negative returns. This is where capital is eroded. So if the present value of your capital investments goes into negative after you've taken into consideration time value of money and cost of capital, and it goes into the negative, then you know capital is being eroded. You may want to make a decision now to put aside a P2 buffer. Also, what you may want to consider are tail events. So apart from your expected risk levels or your expected risk adjusted returns, there may be tail events that you may want to model, right? What happens if, another pandemic breaks out? And then you would also want to cater for such tail events, maybe putting aside a percentage of that loss, reflective of the probabilities of such tail events occurring. So those are the three main perspectives that I would like to take today. Now, so based on those perspectives, we can model strategic risk, right? So I'm going to start from left to right, and I have my laser pointer here. Ed, are you seeing the laser pointer circulating above me? Yep. Okay, great. All right. So I'm gonna give you the high level view of the model that I would have used, and then I'm going to step into each one of these blocks individually to show you in more detail how you could potentially model these things. So the first thing that you need is your sources of risk. So your strategic plan would have defined some initiatives. Maybe you would have ranked these initiatives, and maybe you may want to take the top 5 or top 10 initiatives and move forward with that. Maybe you may want to take all of your initiatives. It depends on what is important to your organization. So then these initiatives or sources of risk has an impact on your revenue and efficiency gains, right? So you may make some projections based on, economic and competitive assumptions. And in terms of the benefits of a particular initiative that you're implementing, a new technology, new training, new products, etc. And these things are expected to have some revenue or efficiency gains. So that's something that you would need to model as well. Of course, these initiatives, these top 10, top 5 initiatives can incur strategic risks and project risks. That dichotomy that I mentioned before, adverse decisions versus poor implementation. Now, if you juxtapose these risks with these gains, and you do that over a time period, because your benefits that you're going to realize may not come right away. They may come increasingly over a number of years. So you juxtapose your risks with your expected gains. You make some temporal assumptions about how those risks line up with those gains over time. And what you would get is a sort of risk-adjusted cash flow. Of course, what you would want to discount, or what you would want to discount to find that present value. Ed, I'm going to ask if you are hearing me at this point, because I saw comments from one of the participants that they're not hearing.
No, still definitely hearing you.
Okay, so, great.
I'll follow up with them.
Right. Right. So now you have a sort of adjusted present value, a risk-adjusted present value of those gains. Then what you would want to do, and once there's an erosion, once there's some erosion from your full potential, right, between your full potential in terms of revenue efficiency gains and your risk-adjusted gains, then that highlights to you that there's some strategic risk involved, and maybe you need to tighten your controls, optimize your portfolio. That being said, it doesn't mean that you have a capital issue. What we need to look at is that these same strategic initiatives will have a capital budget. You would have budgeted some money for technology, training, etc. And that budget is expected to realize some return on investment. When you match that required return on investment with your present value of your risk-adjusted gains, you can then determine if and where you fall over some threshold that you've set for yourself. So I'm going to go into a bit more detail now in terms of this entire process. Just a few assumptions. So again, there's the gains assumptions. Strategic initiatives are expected to result in revenue and efficiency gains in the long term. Strategic positioning assumptions. I personally like to take a conservative approach in assuming that all competitors are implementing similar improvements. So there's some new technology in the market, then your competitors are targeting that technology as well. And so therefore they will all benefit from the same economic conditions. So as the economy starts to expand and grow, and everyone is seeking to update their technology and their products, then any growth in the industry, we could assume that our strategic initiatives are endogenous to that growth, right? So if the bank is expected to grow by 10%, or the industry is expected to grow by 10%, then the strategic initiatives are implied within that 10%. Temporal assumptions, of course, in that benefits may not kick in right away. So you would need to model when and where benefits kick in. You may implement workflow technology today, but it may not be at risk until 5 years from now, because those benefits may not be realized until 5 years from now. And depreciation assumptions, I like to take the conservative approach and assume that my CapEx is fully depreciated after my period of analysis. So that's an expense that I would consider in looking at my risk-adjusted cash flows. So let's get into the methodology in more detail. So the first step is to select your top strategic initiatives. What I simply like to do is I like to juxtapose my initiatives. So you see on sort of the horizontal axis, some initiatives, new product development, customer experience, workflow. These are some generic initiatives that I would have selected that may happen in the banking industry. And on the vertical axis, I have some balanced scorecard objectives: segment growth, customer satisfaction, credit turnaround. So I like to score these initiatives against the objectives and then see how they add up. So I take each initiatives and then I ask maybe a team of experts, or maybe I use some more quantitative or robust method to sort of score each initiative out of 5 against each objective. And then the ones that you might be seeing in green are the ones that would have scored fairly high against all of the objectives. And these are well-leveraged initiatives, meaning that they're touching upon all of your objectives. So this is a useful way for scoring your initiatives and determining which initiatives you would like to go forward with. After you do that, you want to determine how these initiatives contribute to financial gains, right? So one way to do it is that, and this depends on the maturity of your organization. Each initiative ought to have a business case, right? But, in reality, sometimes our business cases don't robustly quantify how a particular initiative is going to affect efficiency or revenues in the long term. So that's the reality. But if you have business cases that do quantify it, then better. In lieu of having robust business cases, another approach you can do is take the assumption that strategy is endogenous to bank and industry performance. I'm seeing a question coming through there, Ed, and I am going to read it out. How do you determine the weighting of the balanced scorecard items on slide 13? So maybe I could quickly address that. Right, so these weightings here, again, I would have put equal weightings for all of these balanced scorecard items. My preference is for equal weightings, because on your balanced scorecard, on your strategy map, you ought not to have too many strategic objectives. And so therefore, the strategic objectives that you do have on your strategy map ought to be the very important ones. So I tend to have equal weightings across. Of course, you can tweak these weightings according to, if you see certain things as being drivers, stronger drivers for overall performance than others. So for example, you may increase the weighting for innovative culture because you may see that as a driver for everything else on your strategy map. Of course, these things can be subjective. You can use a Delphi method, which is round robin with your internal experts. But it's hard to say unless you have been practicing this kind of methodology over decades. It's hard to say because there isn't much historical data to help you weight these things. So it's sort of more of an expert opinion. I guess we could address that further later down after the completion of the slides. Right. So again, in lieu of having robust business cases to tell you, okay, how these initiatives are contributing to revenue efficiency gains, you could use the endogenous assumption in that, let's say your bank or your industry is expected to perform in a particular manner, or things remaining equal. Your finance department usually makes projections in terms of revenue and efficiency. So you may project some sort of efficiency ratio over the next 10 years, and you may project some sort of growth in revenue over the next 10 years based on economic conditions, based on reports that are coming from your central bank, etc. And you lay out these scenarios. And then what you do is that you sort of ask, how does each strategic initiative contribute to these gains? So for example, if I'm expecting revenue to grow by 5% in years 8 to 9, what portion of that 5% growth is attributed to my strategic plan? And of course, again, this is going to require some sort of round rubbing, some sort of bringing some experts to the table using sort of a Delphi method to sort of let everyone interpolate between their opinions in terms of, okay, the overall strategic plan is going to contribute at least 80% to our revenue growth, right? And then out of that 80%, we know that this initiative has a greater weighting based on how we score the rating. So out of that 80% growth, we're saying that 40 out of that 80 is for initiative A. And it's illustrated here in this diagram. So how these percentage contributions vary over time as well, right? So you have to ask, when are your benefits being realized? Because a capex today doesn't translate into benefits today. So your benefits may accrue slowly and then accelerate as effective change management sets in. So you take any one initiative. So for example, workflow system, how does that contribute to revenue, right? And you may say that it's only contributing to 5% of your revenue gains in year 3, but by year 7, it's contributing to 20% of your revenue gains, right? Now, so you take these contributions, these percentage contributions of each of these strategic initiatives, and then you sort of multiply them by your gains, right? So on a previous slide, we would have seen that, okay, finance would have predicted revenue growth over the next 5 to 10 years based on economic situations. And then we also sort of asked the experts, what is the contribution of each initiative, percentage contribution. So when you cross multiply that percentage contribution by the gains, what you get is you've now quantified in terms of dollars and cents a high level estimate of each initiative, how they're contributing in terms of dollars and cents to your gains, to your financial gains. So now you've sort of quantified your strategic plan, right? In terms of dollars and cents. So now that you've quantified it, and we know that, you know, without taking risk into consideration, we know how much our strategic plan is worth. So now we have to take a look at risk. So before, we would have discussed that dichotomy. We have project risk and we have environmental risk. I'm seeing another question coming through. Oh no, that's not for me. So again, you have project risk. Project risk is objectively derived from your project management office. So your project management office should be providing reports in terms of whether your project is on schedule, whether it is minor slippage, whether it is major slippage. And what you can do is you could assign some weightings to each. You could assign some weighting to each status, which I've done here just to illustrate. But of course, these are subjective. And then there's environmental risk. Now, expert opinion can be leveraged where historical data cannot be used to predict environmental volatility. So again, a Delphi method can be used to determine where each project falls in one of the following 5 categories: very low, low, medium, high, and very high. And then, of course, you can assign risk multipliers to each one of these statuses. And then when you cross multiply the two, when you multiply the 2 risk multipliers, what you come up with is a percentage of total gains at risk. So you toggle this now. So you sit down with your panel of experts or senior managers in the organization who are familiar with the initiatives that you're embarking on. And you come up with a sort of a value for the total gains at risk at that point in time for each one of your initiatives. So thus far, we would have calculated the money value or the dollar value contribution of your strategic plan. Now we've assigned some current risk values for each initiative. So the next step is to sort of multiply those gains or that dollar value in terms of gains for each strategic initiative by the risk weighting. And then what you would get is an at-risk amount. So again, this top panel that we're seeing here, that this is your total contribution by strategic initiative. And then these are the risk factors that you would have gotten from considering both project risk as well as environmental risks. And then when you cross multiply, you get the at-risk amounts. So you know how much you've now quantified, how much is at risk in terms of cash flows. And of course, you could determine the net present value of all of these cash flows. You could determine the net present value of the total contributions from your strategic plan. You could determine the net present value of the at-risk amounts. And you could determine the net present value of the risk-adjusted gains. And it's this net present value of risk-adjusted gains is where you sort of compare this to your threshold to determine whether or not you're falling below some threshold that you may now require some P2 buffer, which we'll see on the next slide. Right, so this here sums it up. So we have on this first column, the left-hand column, our strategic initiatives. And of course, we have our CapEx in our year 0. And let's say we've identified some gains required. And our gains required, based on our CapEx, let's say we have a 12% requirement, 12% return on capital. And our CapEx is, let's say, $43 million. Then the gains required is, let's say, an annualized rate of 12% over a 10-year period. That comes up to $133 million. And when we examine our risk-free gains from our initial assessment of the strategic initiatives, it's $159 million. When we find the present value of our at-risk amount, and then we minus that from our risk-free gains, we have our risk-adjusted gains on the second to last column. And you would notice that our risk-adjusted gains, even though it's in the positive, it's $118 million, it's still less than the gains required. Right? So, but from the above, we can see that the total risk-adjusted gains is less than the required rate of return threshold. But this still doesn't mean that you need a P2 buffer. What this means is that you may need to optimize your portfolio. You may need to tighten controls so that your investors are getting return on investments. They're getting value. Now I'm going to show you another scenario. So in this scenario, what I did is that I stressed the model. I would have put most of the projects in major slippage, and then I would have increased the environmental risk to very high on most accounts. And what happens is that your risk-adjusted gains is now in a negative. So you're now seeing a sort of negative cash flow from your strategic initiatives. So this is eroding capital. And you may have to make some decisions around your P2 buffer with respect to this. And I guess the usefulness in this model is that you could toggle between expected risk versus a sort of stress scenario for risk. And you could toggle between different scenarios, of course, and observe the delta between different scenarios. And in observing that delta, it'll give you an idea of how risk impacts your capital and the various levels of risk, and how at each level you may want to set certain policies or certain actions or certain KPIs or key risk indicators for each level. Now, some caveats: the output of the model is not a precise one, so it does not translate directly into a P2 buffer amount. The output can be considered in conjunction with other P2 processes to paint an overall picture for a P2 buffer. And as mentioned before, the output can be assessed along a spectrum of risk levels, identifying the actions taken when the output falls into a given category. So for example, you may set up, let's say, some what I call KRI scenarios, so key risk indicator scenarios. So one of my KRIs is risk-adjusted ROI, and another KRI is risk-free ROI minus the risk-adjusted ROI. So let's take a look at this first scenario. In this scenario, the risk-adjusted ROI is greater than 5% plus our threshold, right? So let's say our threshold was 12%, and I add on another 5 to that, that's 70%. If my risk-adjusted ROI is still at 18%, and then the risk is not taken away from my risk-free ROI, not more than 1%, then this scenario indicates that strategic gains are not being eroded, and by default, capital is not expected. So a recommended action could be is that you're well within risk appetite. Continue executing and upholding existing controls. That's my recommendation. Another scenario is that your expected risk-adjusted ROI now falls below that threshold marker, but it's still greater than 0%. So in this instance, your recommendation may be to optimize your portfolio. Of course, if your risk-adjusted ROI is less than 0%, capital is being eroded. You may then take that figure as a P2 buffer. And if you stress your model, and of course that stressed model is less than 0%, you may take a percentage of the eroded amount as a consideration for P2 buffer. Why I say percentage is because a tail event, you need to factor in that a tail event is unlikely. So you would not want to take the whole amount. So that's the model. That's how you could go about modeling strategic risk. As I mentioned before, it's a sort of a high-level scaffolding. Within it, there's room for you to make it more robust in terms of the values that you're plugging into the model can be determined either via expert opinion, or it can be determined through some quantitative analysis, through some historical analysis. But the model is there for you to plug the figures in and generate certain outputs. And even in lieu of having robust quantitative analysis to plug in your values to the model, you can still plug in expert opinion and then toggle the values to see what is the effect on our P2 buffer, hypothetically. And that can help you wrap your head around what you would need to put aside for a P2 buffer, and at what points you need to set thresholds and tighten your controls. So some limitations and caveats again. Strategic risk is more subjective than other forms of risk, as historical data has little bearing on environmental shocks of the future and the benefits of any strategic plan. If you could model environmental shocks, if you have some volatility type model that you could model these things, then great, you can refine the model, the strategic risk model. It's not a precise model, but it's a starting point for conceptualizing on how strategic decisions affect the bank's capital. And of course, the model would need tweaking and adaptation. For example, CAPEX is not a one-off event. So in your NPV analysis, you may need to factor in CAPEX over multiple periods and not just period 0. So those are some of the caveats. And I just want to move on to the governance bit to close off. I don't know if anyone has any questions on the modeling aspect in terms of conceptually how we come up with the at-risk amount and how we make decisions about the P2 buffer. Any questions at all? All right, so I'm going to a couple of minutes on the governance, and then I think we could wrap up. Right, so the slide that I have in front of you, it lists out these 4 principles under the pillar 2 of the ICAAP. I'm going to focus on principle 1. Banks should have a process for assessing the overall capital adequacy in relation to their risk profile and a strategy for maintaining their capital levels. So this entire model and methodology is supposed to meet this requirement. But of course, we need some oversight. We need some reporting. We need people to own this process. So again, the Basel framework decomposes that principle 1 into some features. And one of those features is board and senior management oversight. So what I've done is I just, at a very high level, an abstract level, I've defined what are the main parties involved in overseeing the strategic risk and making decisions about the P2 buffer. So you have the bank board, of course. They're ultimately responsible to the regulator. And then, as my background is in strategic management, we normally have a sort of a committee that oversees your strategic plan. And this is separate and apart from your risk committee. So banks usually have some sort of risk oversight committee, either a subcommittee of the board or a senior management committee that oversees risk in the organization. And then they also, the risk management functions in the organization, they report into that committee, credit risk, market risk, etc. But also consider that you may also have a separate committee for overseeing the strategic plan, because you have a portfolio of projects. Maybe you have a portfolio management office, or maybe you just have a committee of senior managers that own and oversee these high-level strategic initiatives. So these committees will work hand in hand in terms of overviewing and having oversight of the strategic plan, examining strategic risk on a regular basis, and then escalating decisions about P2 buffer to the bank board. And I guess this slide more or less encapsulates what I just spoke about. The bank's board of directors has responsibility for setting the bank's tolerance levels. So those KRI scenarios that I just set out there, they are ultimately responsible for saying what those tolerance levels are. And the risk committee, they will collate all relevant information about capital adequacy. They may make recommendations and decisions around your P2 buffer. But of course, your strategy oversight committee or your portfolio direction oversight committee, they would run this model on at least an annual basis and provide reports to that risk oversight committee to inform their decisions about the P2 buffer. So that was the extent of which I would want to talk about today, Ed. I guess at this time, I know it's a lot to take in within 40 minutes, so I'm willing to go over some of these slides and field some questions at this point.
Well, thank you very much. So while we wait for people to formulate some questions, I've got one here for you. So given that the ICAAP is an annual process and banks will wish to stress what they consider to be their specific balance sheet vulnerabilities each year, is strategic risk necessarily one we need to test for every year, or should it be more infrequent and we assume that the P2 capital we set aside for it shouldn't be expected to change materially in 1 year, given this is a long-term issue?
Right, it's a long-term issue, but I'm just speaking not necessarily from a risk management perspective, but from what I've seen in the world of strategic management and doing strategic plans and reviewing your strategic plan. It's no longer you do a 5-year plan and you put it in a drawer. There's a lot more bodies of knowledge on, I guess, work is being done around strategic plans in terms of reviewing every year. So your strategic portfolio is something that I would recommend to review every year to optimize. So every year, your senior managers and the owners of these strategic initiatives should sit around a table and say, listen, this initiative is no longer giving us the benefits that we need. Let's drop it. Let's add a new initiative, etc. And especially in these volatile times, you probably may want to do that at least once a year, maybe even twice a year.
Lovely. Thank you very much for that. So I'm not seeing any other question. I'm not sure if any may have come through to you privately, other than people asking if there's going to be a recording. There is a recording. We are recording it now. And then we have to wait for WebEx to process it and everything. So probably tomorrow we'll be releasing the recording and the slides. So, but if we're not seeing any other questions, do you see any, Khaliq?
No, I'm just seeing requests to share the slides. Of course, if the participants, is there a forum where the participants can submit questions otherwise, or this is it?
I think this is it. Obviously, I mean, if you want to give them a way to get in touch with you, obviously, if people do want to sign up to,
I think we got cut off there. Oh, okay.
Okay. I am seeing. Can you hear me now, Khaliq?
Yeah, I'm hearing you now.
Yep, fantastic. I'm seeing a question come through privately here. How successfully has the presented methodology been in practice in linking strategy and risk? They say, how has this methodology been received?
It's fairly new. I can't speak too much about it from an internal perspective because that would be kind of overstepping, in terms of sharing information that I ought not to. But generally, it's seen as a good start. Because we haven't come across, I haven't come across any sort of modeling in terms of translating your strategic plan, your strategic initiatives into conceptually how much is at risk. So it's a good start, and that's the general reception. That's a good start, but also the feedback has been that this is a high-level model, sort of a framework or scaffolding, and then as we move forward, you could refine it according to the needs of your institution, and as you come up with more accurate methods of scoring different initiatives, you will move from, let's say, subjective expert opinion to actually using quantitative analysis for measuring the risk. But the model itself doesn't really change at a high level because you're still plugging in some risk value into the model to see what that output is. I hope that helps.
Right, I'm sure it will. Okay, then. So there we go. I think.
I'm seeing one more question.
Oh, yes. Carry on.
Ooh, that's a good question. How do you link this exercise with operation risk? I guess you can juxtapose the two. You may have models for operational risk, and you could juxtapose the two to make sure that some of the assumptions that you're making are mutually exclusive. But there may be certain circumstances where the assumptions you're making might overlap with operations risk. So therefore, you may want to juxtapose the output of both models to come up with a final P2 buffer, because you may not want to over allocate capital. That might be a misuse of capital. Does the IFRS 9 change the way risk assessment is made? Sorry, I cannot answer that question off the top of my head.
So we've got another one that's come through directly here. Is a loosely related question on CBDCs and its potential impact on ICAAP's bank strategies and regulators.
Could you repeat that question again?
It just says the question is on CBDCs and the potential impact on ICAAP's bank strategies and regulators. I'm not sure if you follow up with more. Or...
Yeah, I'm not quite following that question. Maybe if the person could reframe it. okay, let's say capital buffer is required. How would capital allocation process be impacted? Well, I guess this lies outside of the strategic management process. Again, the governance is how I set up the governance is that once your oversight committee for strategic management has provided that amount or that what you call it, that recommendation for P2 buffer, they would then pass that on to your risk oversight committee, and they would have their mechanisms in place for allocating capital and making decisions around capital. Should this risk be assessed separately or as a driver to other risks? I think it should be assessed separately. And actually, maybe even the converse, that other risks could be a driver to this risk. So if you go back to your strategy map, I think it was on the second or third slide, that sort of balanced scorecard perspective, and you look at the various objectives and how they're linked, you could almost make linkages between operational risk, credit risk, maybe even liquidity crisis, and how those may then impact your strategic outcomes. So I don't see it as a driver for other risks. I actually see other risks as a driver for this because this is more long-term. How can strategic initiative be captured as part of stress testing? Well, so again, I guess that this question takes me back to, let me see the stress testing slide. I don't know if you all are seeing that slide there, where you have listed your strategic initiatives on the first column, and then you sort of come up with very extreme scenarios in terms of environmental risk, in terms of project slipping. So you can make some assumptions about poor project management and about environmental volatility. In the same model, you toggle those values and then see what the delta is from the expected scenario to the stress scenario. You could see what that delta looks like. You mentioned distribution of CapEx when doing FTP. How does this happen given most models FTP default CapEx to Treasury or funding center? This leaves business units off the CapEx. Please clarify in regards to tier 1 and tier 2 capital. So I guess in terms of the tiers of capital, I didn't really think about it in terms of tiers of capital. I just thought about it in terms of capital on your balance sheet being eroded. I suppose that your tier 2 capital is what will be affected first. Your retained earnings, I suppose, is what will be affected first. So if it is that you spend a certain amount of money, conceptually, you spent $1 million on some new system, and then you expect some return on investment, but you don't get that return on investment. Let's say the system is a flop. It doesn't give you any benefits or gains. And on top of that, you have to now write off that investment because that asset, that cash now becomes an asset on your balance sheet. There's some sort of system or technology. And after a certain period of time, you have to write off that asset. Now, you've written off the asset and you've got no return on capital. So therefore, that is an erosion on your retained earnings, to me, in the first instance. That's how I would look at it. But in terms of framing it in from a tier 1 and tier 2 capital, I didn't really give that much thought as yet. My angle was more from how does the strategic management process spit out an at-risk amount? And then how do we interpret that risk at-risk amount in terms of whether capital is being eroded or not? Sorry, I couldn't help more on that question.
I think we may be reaching the end of the questions then. Looks like people finally started asking them. So I would say we were saying about whether people would be able to discuss further later. We don't with these free webinars have a particular forum or anything like
Right.
that. Of course,
Right.
I can see that a lot of our attendees are either current BTRM students or their alumni. So we of course have our discussion forums still available for them. And of course, if anybody wants to take the BTRM, then they will then they're welcome to do that, and they will be able to get onto that alumni forum as well. And obviously, if people come to the BTRM conferences that we run as well, then we always have discussion forums set up for those. But otherwise, I'm not seeing any more questions. So I think it looks like that's all for today, everyone. Once again, our thanks to Khaliq Ali, who is with First Citizens Bank in Trinidad and Tobago, has been presenting today on strategic risk management and the ICAAP. My name is Ed Dennison. Thank you very much for your company today, and we hope to see you soon at another webinar. All the best.
Thank you all. Take care, Ed.